Performance and Incentives, Part 2, Residual Income, Economic Value Added. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email address and our phone number. You can find more information. There was some good video on this, both PowerPoint and text, on a textbook that we had from McGraw-Hill Urban on this topic. We want to continue the discussion on incentives, performance incentives. And the question now is, how are you evaluated as to whether you met these performance incentives or not? Two new terms here, residual income and return on investment. And we may have a conflict between the two. We may have a project that is profitable based on residual income, but our overall return on investment on all of our projects may decline. So there may be a conflict, and let's show you what we mean. Here's an example of residual income. We continue with the examples from Performance Incentives 1. Crazy Kids Jeans has investment, sales, expenses, and we calculate a $10,000 profit. We use this line of data to calculate a return on investment of $10,000 divided by 50, or 20%. And now we throw in the additional information on residual income. And we say that on $10,000 investment, we have a required minimum rate of return, a minimum that we've calculated of 7%, which means we have an investment charge of $1,500. There's a cost of that capital, and we'll talk about how we calculate a cost on capital a little later. It's $1,500. If we take the operating earnings of a project at $10,000 and subtract the $1,500 investment charge, we come up with positive residual income of $8,500. I put an asterisk because you can think of it as income over and above the required minimum rate of return. Residual means what's left over. Now you can think about it as the operating earnings on the new $10,000 project. You can think it as the operating earnings on all the projects put together. But we do use operating earnings. So it would seem that based on residual income, this would be a project we took on if the project had operating earnings of $10,000. And I put the $10,000 there just to emphasize that it can either be all your projects or just one. But let's recalculate our return on investment now that we have two projects instead of one. So I've added information on the new project at the bottom. Average investment, sales, expenses, profit. This column represents profit as a percentage of sales. And I'm going to type in sales there, just so it's clear. And make that a little bit bigger. Because that profit as a percentage of sales is different from return on investment. So I'm trying to emphasize that. The profit as a percentage of sales is 10% on the original project, 8% on this new project, or 800 divided by 10,000. If we take our total profit both projects and we divide it by average investment both projects, we get a return on investment of 18%. That is lower than the 20% that we had with only one project. So what might happen is, you have a project with positive residual income that you think you should do, but it brings down your return on investment when you look at all your projects as a whole. So one says do it, the other says maybe not. So the question that I have in brown is, how are you evaluated? Are you evaluated based on residual income or on return on investment? That's why I have here at the last bullet point, maybe your project is profitable based on residual income, but in terms of total return on investment, it actually decreases. That brings us to our second term, economic value added. And if you think about our basic balance sheet formula of assets minus liabilities equals equity, EVA, economic value added, means how much shareholder wealth is generated or added, which also means how much equity is added. Another way I say it is your profit after your cost of funds, because the funds you get to run your business have a cost to them. I always started my securities classes by asking, there's two ways to raise money, what are they? Well, we can borrow money. We might have interest expense on a loan, that's debt. We can sell ownership, which is equity, and we might have required payments like a dividend on the equity. So cost of capital can be thought of as the after-tax cost of borrowing, if it's debt, or equity, going out and getting the equity. So I've got an economic value added example here, and what I've written next to it is more money in the equity bucket. Do we have more money in the equity bucket afterwards than we did before? So here's the same Crazy Kids gene data that we had on the prior page. And this time we're going to look at a balance sheet for Crazy Kids genes. We have assets less liabilities equals $20,000 in equity left. And on that, I'm going to suggest that we have a cost of capital of 7%, which means a new term, we have an investment charge of $1,400. That's how much it costs to go out and get that capital. If we take our after-tax profit of $10,000 and we subtract the investment charge of $1,400, we have EVA, economic value added, of $8,600. In other words, we have $8,600 more in the bucket than we did when we started. I'll wrap up by saying there are three ways to increase that EVA. The first is increase profit without adding capital. If you've got 2 ovens in the restaurant and you can sell 20% more food, you're getting a higher return on the same assets or capital invested in the ovens. Alternative 2, use less capital to make the same amount of profit. Maybe you have 8 employees in the restaurant instead of 10, and you're selling the same amount of food with lower cost. It doesn't cost you as much capital. You don't have to have cash invested to make as much payroll, to meet as much payroll cost. The third one is you invest capital and earn a higher rate of return. So you were earning 10% on your capital, and you find a way maybe to be more efficient and invest money in your business and get a higher rate of return, maybe 12% instead of 10%, because what you invest in makes you more profitable. That's the end of part 2, performance incentives. You'll find part 3 on YouTube. Our YouTube channel, Ken Boyd STL, all one word. There's a complete list of our videos on our website, stltest.net. We do live tutoring and chat sessions, both one-on-one and in groups. That's it for now, and we'll see you next time.